Hello traders, welcome back again. So in this video, we are going to be explaining what pips, bid price and ask price, lot size, what they are in forex trading. Okay, if you are new to this channel, we are right way traders. We deal with forex realities for retail traders. So if you are new, make sure you go through our channel and see if these resources here are going to be helpful to you. Meanwhile, this is the third video we have under the playlist on forex terminologies, explaining forex terminology. So if you want to be buying and selling currency using the trading platform I explained last week, then you need to understand what pips, bid price and ask price, and lot size, what they are, very essential for executing trade. First of all, let's start with pips. What is pips? Okay, or let's say pip. A pip is the smallest unit of a currency pair exchange rate. Okay, I always like to use the Euro USD example. Let's use the Euro USD example. Okay, what is a pip for the Euro USD? A pip is the smallest unit that the currency exchange of this currency can change. Let's say this is the current exchange rate. Okay, let's put 5 here at the top. When you open your forex trading platform, you see stuffs like this. A pip is the last four digits, okay, counting from the decimal point, the last four digits after the decimal point. So 1, 2, 3, 4. That is what a pip is, okay, for every single currency pairs, apart from the JPY pairs, which I will get to. So if that's the pip, if you want to say that this exchange rate increased by 1 pip, it means this exchange rate is going to be 1.1551. Okay, put this 5 here. This value that I seen at the top is what we call pipette. It's the next unit after a pip. Okay, like 10 pipettes makes 1 pip. That's why you see me write 5 here. So if it gets to 9, 10, then this one is going to change. So if this had increased by 1 pip, it means the last four digit number for after the decimal point is increasing by 1 pip. If it increases by 10 pip, another example, if it increases by 10 pip, this is 1 pip. Increases by 10 pip, which means the last four digit number, add 10 pips to it, it's going to give you 1.156. This value, remember, 0.5, increased by 10 pips. So in forex trading, pips is what we use in measuring currency pairs. Okay, apart from the JPY pair, which is the Japanese yen, the Japanese currencies. Okay, this one, the pip is actually the second number after the decimal point. Let's say you have the GBP, JPY, and the current exchange rate is 285.15. This value here, the second number after the decimal point, is the pip. And if you say this currency rate increased by 1 pip, it means it's going to be 285.16, and the pipette is normally here. Okay, at the top side. Just forget about the pipette, you have nothing to do with it. Think of the pips. The pips is very important in trading. That's what you use in setting many things like driving your stop loss points, arriving at your lot size position, and even anticipating the move of every currency. So it moves in pips, so you have to use pips in measuring every single thing in forex trading. So that being said about pips, now you understand what pip is. Let's go and talk about what bid price and ask price is. Bid and ask price, what are they? If you are looking at your forex currency or forex trading platform, you see the chart. Then if you look at the chart, actually you see two lines. That is the difference between the ask price and the bid price. The ask price is what your broker is willing to offer to you if you want to buy a currency. The bid price is what your broker is offering to you to buy back that currency from you. That is, you want to sell. That is the bid price. They have to be different so that your broker can make money in exchanging rate. That's why immediately you buy or you enter a trade, you see loss immediately. That's because of the difference in bid price and the ask price. Okay, so the ask price is where your broker is willing to sell to you. Okay, then you buy. Then the bid price is where you sell. Okay, now let's go back to the currency exchange rate that we're talking about. Going back to the Euro USD, 1.155. Okay, you will normally see two prices there. Okay, 15515. Okay, this is what you likely see in your trading broker platform, right? So this right here is where you sell. This is the bid price and this is the ask price. The ask price is always higher because that's where your broker always want to sell to you. They sell to you at a higher price and buy from you at a lower price. So the ask price is always at the top and the bid price is always at the bottom. Okay, but in this case, this is the ask price because it's higher. Any number that is higher is the ask price. The lower one is the bid price. Now, the difference between these two price in pips, if you look at it very well, is just one pip. Okay, one pip. This means that the spread of this trading account is one pip. Okay, so when you hear about spread in forex market and everybody wanting a low spread, it's so that the difference between the ask price and the bid price should be lower, which is one pip in this case. Okay, is the spread. So the higher the spread, the more disadvantage it is to you as a retail trader because that is where your broker gain from. You now understand what ask price is. It is where you buy. The bid price is where you sell, and then the spread is the difference between those two. Now that being said, what is lot size? Forex trading is being traded within retail traders in leverage. If we don't have the leverage that these brokers are giving to us, we cannot make money. We cannot make significant money. If we are just trading at the spot market, which is like the bank exchange rate directly, we will not be able to make enough money because we don't have that large sum of capital that will cover for the profits. Okay, so that is why they provided leverage. And in provision of the leverage, we have what we call lot size. Lot size is the amount of units of currency you are buying or selling. Okay, so we have standard lot size in forex trading. We have a mini lot size and the rest. But in this video, I'm definitely going to talk about only standard lot size because this is where retail traders find themselves the most. Okay, now in forex trading, standard lot size actually means 100,000 units of a forex currency pair. Okay, 100,000 units. One lot size. One lot size. Okay, 100,000 units is equal to one lot size in a standard lot size calculation, which means if you are buying, we are going back to that currency pair again. Okay, if you are buying this product, it means you have dollar to buy the euros. Okay, you are buying it in one lot size. One lot size, it means you are actually trading with $100,000. Okay, so it doesn't matter what your account balance is, what your capital is. Okay, if you are buying with one lot size, it means you are trading with $100,000 on a standard account. Okay, so whatever happened to that exchange rates now will not affect your trading capital. So lot size is the unit or the amount of currencies you are buying, which is why it's important in trade risk management, in trading, in risk management. It's all about lot size. Okay, risk management is all about trading lot size. The amount of lot you are using to buy a product is what will affect your stop loss, which is your risk in every given trade. For every given trade you want to enter as a trader, the first thing to note, or after running your analysis before you enter that position, is how many lot size you need that will balance your stop loss. This might be a little bit complicated, but as we are going further, you will get to understand why I'm explaining these terms. Okay, so going further into tutoring you about forex trading for retail traders, you get to understand about lot size and why we call it like in this way, why we use standard lot size in trading. So if you have one lot size, like I said, it means you have $100,000 of position in that particular pair you are trading. That being said, this video is just to explain the terms, okay, and why we use them. So lot size are basically used for trading and buying the quantity of pairs that you want to trade with. Okay, and they are measured mostly in the standard lot size, which means one lot size is equal to 100,000 units of that product that you want to trade. Okay, that will be that for now in this particular video. On our next video, we'll be explaining what leverage is, stop losses, and every other single terms that will be confusing to a beginner trader. I'm going to explain it for you guys. See you there. Make sure you have liked this video and share it to anybody you feel is going to be important to.